Should you pay off your mortgage early or not? Let's look at the data. By the way, if you want more videos like this, breaking down the data behind investing, be sure to subscribe so you can join the Market Moment community and get notified every time new videos drop. Today, I want to briefly summarize a study on whether you should pay off your mortgage early or not performed by honestmath.com in February of 2022. The premise around their study is that the conventional napkin math used by individuals and advisors alike does not provide a comprehensive understanding of whether investing or paying down your mortgage is better. They state, we demonstrate that an investor can benefit from paying down a mortgage in favor of additional portfolio contributions even when the investment return exceeds by a sizable margin the cost of the mortgage. This goes against what most individuals state, that if your mortgage is less than the average stock market returns, you should invest in the market. There are a lot of assumptions made by them in their model, so I will link the article in the comments below so that you can familiarize yourself with all of the details. But here's a summary of their study. All of the scenarios begin in 1992. Each example refinanced every 5 years as interest rates fell, while investing all excess cash in the S&P 500, which earned a return of 10.7% over the 30-year time frame.
So let's look at the results. Investor A pays nothing extra on their 30-year mortgage and invests all extra money into the S&P 500, assuming a 15% capital gains tax. This results in an ending net worth of $5,166,485.
Investor B takes out a 15-year mortgage and invests all the extra money into the S&P 500, still assuming a 15% capital gains tax. In this scenario, you can see the ending net worth is $5,150,999. Basically, it's the same. Now, it should be noted that their interest rates started at 7.17 and eventually made its way down to 2.72, and that past historical returns are not indicative of future market performance. But there are a few takeaways from this. Paying down your mortgage versus investing is not as simple as the interest rate being less than or more than your expected future returns in the stock market. Things like capital gains tax, tax deductions, market returns, mortgage interest rates, and many other factors play a role in the decision. The best possible outcome between paying down a mortgage versus investing will only be known after the fact. But before I go into that, make sure you like this video if you find it helpful. It helps us know we're on the right track towards making financial literacy easier to access and understand. So, how can a data-driven investor create guidelines for themselves around all of this? That's a great question, and one that I really don't want to create hard guidelines around because it will look different in different economic conditions and even in different personal scenarios. So I'll give a few things to consider before you start paying extra on your mortgage. First, do you have an emergency fund?
Without an emergency fund, there's a higher chance that you will need to use consumer debt like credit cards to pay for unexpected expenses, which stops any form of discussion on whether you should invest or even pay down debt.
Do you take advantage of all employer matches? Employer matches provide a 100% return. You will likely never receive a 100% return from paying down your mortgage or investing in the market long term. Will you invest every dollar if you don't pay off your mortgage? In the scenario above, they assume if you do not pay down your mortgage, you take every dollar that you would have used and invested it. If you do not do that, then the scenario is not accurate, and you probably should have used the money to pay down your mortgage. What is your expected long-term return with your current investment strategy? As your portfolio becomes more conservative, then your expected long-term return from your portfolio goes down. This means paying off a mortgage becomes more beneficial because your expected returns from paying off your mortgage and investing come closer together. That is why you will often hear that you shouldn't pay extra towards your mortgage when you are young and investing aggressively, versus when you're older and investing more conservative. Have you been able to withstand downturns in the market in the past, and do you expect to be able to do this in the future with a larger account balance and when you're closer to retirement? If you cannot withstand downturns in the stock market, then you likely will not earn good long-term returns by investing in the market. Then it is likely best to pay down your mortgage instead of investing in the market. What is your timeline until retirement, and will your home be paid off before then? Paying down a mortgage is a guaranteed return, and investing in the market is not. As an investor nears retirement, it could be a consideration of guaranteeing returns by paying down their mortgage instead of taking risk and investing, especially for a risk-averse investor. Is your interest rate relatively high or low in relation to how much return you expect to get out of your portfolio? If someone has a 2% mortgage rate and are only able to earn 3% on their portfolio because they're invested in CDs, it could make more sense to pay down the mortgage. But if they have a 2% mortgage and they're fully invested into stocks, their expected return is likely much higher than 3%, and it could make more sense to continue investing. This all changes with the mortgage rate environment that an individual purchases their home in. Honestly, I could keep making more and more questions. The takeaway for most investors is do what is best for you in your life and do not waste another second regretting the decision that you make. Choosing to pay off your debt or invest in the market is better than not choosing either of them. In this case, inaction is the worst action. And if you're curious about how much you should be saving for retirement, here's a video for you.